Good afternoon, everyone. My name is Luke Rollins, and we are Chester Consultancy. Today, we will be presenting our analysis of Team Andrews, their performance and decisions over an 8-year period. Introducing our team, Natalie Redman will be reviewing specifically Andrews' performance. Michael Umbers will be discussing his analysis of the executive shake-up and the effects on the company itself. I will be presenting an evaluation of the future potential of Andrews and recommendations as such, and Jacob DeLima will be presenting lastly his analysis of Andrews' competition and comparison and concluding. We hope in this presentation to provide you with relevant and credible information upon which you may base your investment decisions. So thank you for listening, and without further delay, please welcome Natalie.
Over the last 8 years, Team Andrews has had a few rough years, especially with their market share slowly decreasing until 2026, when they lost all their market share altogether. This is due to Andrews operating at a loss, with some quite large losses of over 9 million in 2021 and 2023, and then their largest loss of over 11 million in 2025. Andrews actually only saw a profit in 2026 when they sold off a majority of their company's capacity. These large losses led to Andrews requiring emergency loans in 2019, 2020 and 2025, with their largest emergency loan being in 2025 of over $25 million. Unfortunately for Andrews, their stock price decreased to $1 in 2020 and remained at $1 for the rest of the 8-year period. We also observed that Andrews sold off their capacity for their product AFT in the performance segment in 2023. After resulting in a negative overall contribution margin in 2025, we observed Andrews sell off their company in 2026, resulting in a 0% market share. So where did Andrews start? Well, Andrews followed a niche cost leader strategy. They set out to produce low-costing products in high quantity to engage their target market and keep prices low while turning over a profit. Andrews wanted their prices to be lower than competitors, however still be competitive in the market. Their products were to start in the high-end market, move to the traditional, and end their life in the low-end market. Andrews also planned to increase automation to reduce the cost of production. Andrews only wanted to finance through long-term bond issues on a need-only basis to eventually work towards a profit and give back to their shareholders. Since Andrews finished this 8-year period with 0 products in the market and a 0% market share, it is evident that they didn't follow their strategy and didn't achieve their mission. Unfortunately for Andrews, they made a few mistakes, which led them astray from their strategy, left them with losses and 0% market share. A major mistake made by Andrews was their financing. In 2020, they had a large long-term debt retiring of $18 million, which was made from a previous emergency loan in 2019. Andrews only decided to finance $12 million, even though they had a loss from operations. This obviously led to another hefty emergency loan of over $10 million. In 2025, Andrews also financed incorrectly. They had a large long-term debt retiring of over $20 million. However, for some reason, decided not to finance at all. This led to Andrews' biggest emergency loan of over $25 million, which eventually led to Andrews having to sell capacity and cease production. Another mistake made by Andrews is they didn't follow their strategy. They set out for their products to move from the high end into the traditional and in the low end market. However, they constantly adjusted Able, their product in the traditional segment, to fit the buying criteria of the traditional market. This prevented Able from drifting into the low end as their strategy stated until 2025, when it finally fell into the low end market. Even if Andrews wanted to keep Able in the traditional market, since it was doing so well for them, they adjusted the reliability to be outside of the buying criteria. Andrews did the same with their products Atom and Agape from their high-end and size segment. They always adjusted their buying criteria to fit their current market perfectly, not allowing them to drift into the low end as their strategy stated. Andrews really focused on their product Acre, ensuring it fit the buying criteria perfectly for the low-end market. However, in 2025, they reduced the reliability to be outside of the buying criteria, losing them valuable sales and market share. In 2025, Andrews only had 3 products left: Able and Acre in their low-end segment and Atom in the high-end, which clearly isn't in line with their strategy. In regards to ethical considerations, Andrews considered their employees and underwent labour negotiations in 2022 and again in 2024. As you can see in the graph, the blue line highlights the labour negotiations of 2022. Unfortunately for Andrews, the adjusted labour wage was slightly higher than their ceiling price, leading them to experience 19 strike days. This also led to a higher starting price in the 2024 labour negotiations, indicated by the orange line. As you can see in the graph, Andrews actually set the labour wage in 2024 at $44.68. The labour increases are great for employees. However, in the long run, wasn't so great for Andrews. After the 2024 increase, Andrews actually stocked out in many of their products and had their smallest loss in this 8-year period. They even had a small increase in their market share as well. However, with this new increased wages led to increased labour costs, which Andrews couldn't cover in their operations. So in 2025, they actually ended with an overall negative contribution margin, meaning that their loss was larger than the amount of fixed costs and expenses. So even though these labour wage increases were ethically positive for employees, it had a negative long-term effect on Andrews' operations.
Thanks, Natalie. My name's Michael Umbers, and I'll be looking at the analysis of the executive shake-up for Team Andrews. In particular, I'll be looking at the company's status following the shake-up, as well as the strategy changes that occurred over this time. Firstly, looking at the company's status after the shake-up, we can see that the shake-up began in the year 2023 and went through until 2026, so it was a 4-year period. Over this time, Andrews experienced quite poor results, but I will say within the year 2024, there was some improved results, with sales and all major indicators improving. In this same year, there was aggressive labour negotiations which Andrews led. They actually set the wage costs for the industry, which we'll discuss the implications of in the next section. We can see here, we're looking at one of the major indicators being sales, is that Andrews actually increased their sales up above the 70 million mark in 2024. Now, this is as a direct result of those labour negotiations. By setting the wage costs so high, what that did was it actually put some strike days on some of the competing companies within the industry. This meant that those companies couldn't actually produce on those strike days, meaning their capacity and what they could sell to the market was greatly reduced. This meant that Andrews, even if their products weren't as wanted within the market, were able to sell those products because there was literally nothing else within the market to sell. This is why their sales in that year actually increased. Following the year 2024, once the competing companies were back at capacity in terms of output, you can see there that their sales dramatically declined once again, which had been the similar trend prior to the executive shake-up and the labour negotiations, all the way down to $0 worth of sales in the year 2026. Looking at another major contributor, or major indicator should I say, is contribution margins. Now again, in the year 2024, we can see that the contribution margins were above 30%, which isn't a bad figure. Unfortunately, there was an immense decline in 2025, with the contribution margin actually going down to negative 7%. Now again, this is a direct result of those labour negotiations. By setting those wages so high, it actually meant that when they sold a product, they actually sold it for less than it cost to make. Okay, so hence the contribution margin was a negative figure. Now, those sharp increases in wages is exactly what created the contribution margin to be negative because those variable costs went up so much. In the year 2026, they scraped back to being just above 0%, but that's mainly because they didn't actually produce any products in that year and sold off all their capacity bar the one product. Looking at the strategy adjustments, the first thing I'd note for Andrews is, was there a strategy in the first place? As Natalie's highlighted, the initial strategy was a niche cost leader, but as we see within industry, having a strategy and implementing it are two different things. Implementation can be a lot more difficult than actually coming up with a strategy, and that's exactly what Andrews struggled with. They really struggled with actually implementing the strategy and having key indicators which showed that they were actually following a strategy whatsoever. Looking at some of the strategy from the executive shake-up, I'd say initially it was extremely aggressive. Now, I relate that both to Labor and TQM. So firstly in Labor, as we spoke about, they set the wage cost in those Labor negotiations, and in TQM, they invested heavily with $1.5 million investment in each of the TQM initiatives. Following that year of 2024, they were extremely passive with limited changes to products from 2023 to 2025 and no more investment in TQM initiatives. If we quickly go back to both looking at our sales graph there with a steep decline in sales and a steep decline in contribution margins, we can then see why there was quite a passive strategy following that, both in the changes to products and TQM, because simply there was no money to invest in those areas. As we've already mentioned, and we'll highlight further, in the year 2026, Andrew sold off all products except for Able in 2026. I'll now pass you over to Luke to talk about the next section of our presentation.
Thank you, Michael. As already stated, Andrews has continuously made losses, accumulating debt and emergency loans over the 8-year period. To discuss then Andrews' future performance and what we might suggest as a strategy were we to take over management of the company, I've analysed Andrews' current position as of the 8th year and what and if improvements could be made. Currently, Andrews has one remaining product, Able, within the market with 1 unit of capacity available to them next year. All other products and production capacity has been sold off. While they have $0 of current debt, long-term debt remains at $32,494,000 with cumulative losses of $47,218,000. To repay these debts, they currently have a net cash position of $22,929,000. Share issues stand at $1. To make improvements then and make Andrews a financially successful and competitive company, we would obviously need to reintroduce products into the market in order to generate revenues. To do so, however, would be exceedingly costly. Capacity would need to be purchased at its full price. Products would need to undergo extensive research and development, and these would then need to be heavily marketed and promoted. Given, however, Andrews' limited budget, these investments would need to be heavily financed. Unfortunately, due to its low share price of $1, issuing shares would not be a viable option, requiring Andrews to acquire further debt. Now, examining the industry, while we can see that Chester is slowing in its performance, Baldwin is improving, and Erie and Ferris continue to absolutely dominate the market. To enter these segments and be competitive would prove to be extremely difficult for Andrews, even with new products. Even if they managed to gain a foothold, it would take a number of years before these products were able to generate considerable profit or even revenue, by which time they will be obligated to pay outstanding debts of considerably large amounts and to be unable to do so. Given this information and forecast, in an effort to ensure that Andrews does not encounter further financial hardship or debt, it is recommended by us that Andrews shuts down their operations and becomes insolvent, liquidating their assets and inventory to repay outstanding debts effective immediately. While this may seem extreme, given the exceedingly difficult financial position that Andrews has fallen into, winding down the company is the only way to mitigate further risk of debt and would be the only financially viable option.
Hi, I'm Jacob and I'll be talking about the competition analysis. So the worst company in the industry is Andrews, as they received a final overall score of 28.7. Andrews had 3 emergency loans over the 8-year period and only made a profit 1 year, which was in their 8th year. Their capacity and production was at 0 and market share at 0% and had the equal lowest stock price. Andrews had the lowest total assets and an extremely low percentage of plant utilization. Their traditional low-end and high-end segment were all at 0% as well. They also had the lowest cumulative profit of over negative 47 million. The best team was the computer team Erie, receiving a score of 95.5. Although excluding the computer teams, it was out of Baldwin or Chester as to who was the best performing team. Baldwin had the highest final score relative of 58.9, whereas Chester were in a close second with a score of 57.5. Comparing the two teams, they both had similar scores, as Baldwin and Chester almost had exactly the same average asset turnover. Their average market share was also very close, with Baldwin scoring 11.69 and Chester scoring 9.66. However, the major difference separating these two teams was their cumulative profit. Chester's cumulative profit was significantly higher than Baldwin's, as they made a cumulative profit of over 2 million, whereas Baldwin had a cumulative profit of minus 40 million. Taking these facts into consideration, Baldwin was still the team that came out on top with the highest final score of 58.9, just beating Chester and significantly beating Andrews. So compared to the other teams, Andrew was the poorest performing team. They had the most emergency loans and the lowest sales, variable costs, cumulative profit, stock price, total assets, and turnover rate. Andrews ended up selling all of their segments except for one, which is their traditional segment Able, in which they still struggled to sell units for. Andrews' cumulative profit was also at minus 47 million, whereas Chester's was over 2 million. Andrews started quite poorly, having an emergency loan in their first 2 years. A possible solution for this was to get rid of any product in their performance and size segment, and to just focus on their traditional and low-end segments. This could have potentially increased their production and analysis. So overall, Andrews' company's strategy was niche cost leader. Their biggest mistake was not financing correctly, which led to 3 emergency loans and long-term debts, and also they were not following their strategy. Andrews ended up selling all their products off except for Able, where they still struggled to sell their units for. Their major indicators were their decline in sales and contribution margins, and Andrews had a high long-term debt and cumulative loss. Their recommended future strategy would be insolvency to reduce the risk of further debts and to liquidate their remaining inventory.